what has caused the last 18 months, 2 years, what has been the contributing factors behind the gold price rise? And then subsequently silver, I think we're seeing copper as well.
Yeah, well, let's just deal with gold, because I think silver kind of tends to follow gold, albeit lags it. I think a lot of it is really the fundamentals, which is I refer to them as MIDI because it helps me remember them. But you've got market uncertainty, bags of that. You've got tariffs and geopolitical situations, interest rates, which can come on to, which was one of the reasons behind the correction on Friday, debt and inflation. So I think those four factors. The view is that the market's very uncertain, interest rates are going down, debt's going up, inflation is going up. And I think that is what's been driving the prices, which has been increasing the prices over the last 12, 18 months.
Okay, and then what?
Central banks have been buying as well, and there's lots of other things, but I think those are the four key things.
Okay, interesting. And then I suppose kind of one of the key factors that I see reading the news is about the value of the dollar and the relation to gold. So if the value of the dollar falls, gold tends to rise. However, obviously historically there was a formalized coupling between the price of gold and the value of the dollar. Why does this correlation still happen despite the gold standard not existing for getting on for, what is it, 55 years now?
Yeah, I think people are very conscious of their purchasing power. So, almost regardless of what happens to investments, dollar, they want to retain their purchasing power. And so that's one of the reasons why I think that people have, I'd say, added gold to their basket. They haven't. I don't think people are walking away from the dollar or anything like that. I think they're just including gold in their basket, and so gold has gone from literally sort of no one having it to a few people having it, and that is what's caused a drive in the price. And so I think that people are looking to diversify their asset base, and there's a lot of press about not just the dollar but lots of currencies, and I think people are just like thinking, okay, well, I'm sure it'll be okay, but why don't I have just a little bit of gold or silver or whatever it is? And I think that's even a small fraction of people's money going into gold and silver has made quite a dent in the market.
And where is a lot of this coming from? So we see kind of investor flows across lots of different markets. Some will be driven by institutions and traders and professionals. Sometimes you get, GameStop driven by, retail traders. Where is the interest and the money flowing from into gold that's causing this price? Is it central banks? Is it professionals? Is it retailers, or a mixture of everyone?
I think it's a mixture of everyone. I mean, central banks have certainly been active. I think that they are probably getting to a point where they'll still be active, but perhaps not buying as aggressively. But gold has certainly hit the mainstream. A lot of people are talking about it, and as I say, I think even just having a small fraction of their portfolio in gold would increase the price. And I think there's also a bit of price discovery going on, which is really what we saw on Friday, because Friday was margin calls were increased today, but what you had on Friday was a lot of deleveraging. And the trouble is, when you have a sell-off in the derivative market, a lot of stops get hit, and then you get a sort of self-fulfilling prophecy, whereas everyone's sort of rushing for the exits at the same time, and that can cause a tremendous drop in the price, which is obviously, gold came off a lot, but silver came off a huge amount. And I think that over time, and I don't know how long it will be, I'm guessing weeks, there will be a price discovery where people say, right, the physical gold price is comparable to the paper gold price, and likewise with silver. I think when you get to that kind of parity, then I think the markets will calm down a bit. But I do see some significant volatility over the next few weeks as that sort of price discovery takes place.
So explain what happened on Friday a bit more for me, because I myself and a lot of my viewers will kind of be interested in financial markets but not really understand the ins and outs of it. So you say that a lot of stops were hit. Was this because it was the end of January and trades were?
I think it was a bit of a perfect storm. I mean, the Trump announced the new potential head of the Fed is obviously not formally confirmed yet, but I think it's very likely to be decided. And he was basically saying that he did not want interest rates to perhaps fall as much as some people were expecting. So because of that, I think people are kind of expecting a stronger dollar. Now, a stronger dollar is obviously good for the dollar, not good for gold. And so that was a contributing factor, but I don't think that was the only factor. And I think there's also an element of proof in the pudding that I think he's got a tough job, and he's talking about changing models and things like that, and probably looking further ahead than closer. But I'd be very surprised if the existing Fed didn't do that as well. And so when he comes in, I think it's probably May time. I don't think things will change that much. And Trump's put a lot of pressure on Powell to cut rates, and I think that it's unlikely that the incumbent will come in. Sorry, not the incumbent. The new guy will come in, and he won't cut rates. And so I do see gold being a good asset to have in your portfolio over the longer term. But as I just said, I think there'll be a lot of volatility over the next few weeks. So it may not be a great time for people to get into the market if they're concerned about volatility.
And speaking of volatility, there's been a large metal sell-off kind of period in the last few days. So this has been, as you've explained, the volatility in gold, but then silver's been hit really hard. Copper prices have been hit hard. How do all these metals correlate when it comes to their market price and the buying and selling of them? Because personally speaking, as a retail investor, I don't think I'd ever look at necessarily investing in copper. But obviously these things are traded by the market continuously. But how are they all linked together? Because that's maybe something that I don't fully have my head around.
Yeah, look, I mean, I think you have to be quite careful about linking them together, because they are all very different metals. They've got different markets. Silver, for example, is very big in solar. It's very big in electric cars, and it's being used increasingly in clean tech. Now, I don't know what that means in terms of increasing demand overall versus where it used to be, because obviously it used to be used in photographic and things like that. Now, you probably find one's gone down, the other one's gone up, but it's kind of like there's clearly a lot of demand for silver. As we just touched on gold, there's a lot of demand for gold. Copper I'd view as probably a more industrial metal, but there's certainly talk of shortfalls in copper supply. So I think the big kind of news is I think we're kind of entering a market where the physical will drive the market. I think up until now it's the paper that's driven the market, but with the sell-off on Friday, it'll be very interesting to see what the price discovery is over the next few weeks, because it's all very well having a spot price in silver, but if you've got physical silver going for a lot more than the spot price, then you don't have a you don't really have a price. And I think that what will happen is, especially with these margin increases, it'll take some of the froth out of the markets and it'll bring the price down. But I think the paper price will probably go up as well. And so at some point they will kind of meet and everyone will go, yeah, well, that's a fair price. But I don't think at the moment people really know. And that's one of the reasons why we've got an awful lot of volatility, because I think it's going to take a while for people to kind of work out where we are. And when we hit the price where the paper price and the physical price are much closer together than they are at the moment, then I think we'll see a lot more stability in the market.
And when you say the paper price versus the physical price, I can get my head around what the physical price would be. I physically go and buy a gold bar, and that's how much it costs. In terms of the paper price, what does that look like for a retail investor? How would I be given that information?
The COMEX is the main source, a common source of pricing, and that's where you would probably you would see the gold price and you say, well, that's what it is, and quite rightly so. But if you actually wanted to buy physical gold, then you may find someone wanting a different price to what the COMEX is. And what they may do is they may say, right, well, the COMEX price is X, but I want to buy some gold and it's going to cost me X plus Y. So if I'm going to sell it, I'm going to sell it for X plus Y plus Z, so I can make a bit of profit. And I think that's kind of the rub, and that's what I talk about, the prices coming together. I think that when you get a spot price, which is what you can actually buy the physical for, then I think you'll get a lot more stability in the market. But I think it will probably take a bit of time for that to feed through, and until it does, I think there'll be a lot of volatility.
So I've been looking at the price of gold increasing, really well, and I want to invest in gold. I want to add it to my portfolio. As a retail investor, how do I go about doing that, short of buying a gold bar, keeping it in my own house? Because this is maybe something where I don't think end retail investors really understand how they can invest in gold, short of physically going and buying the stuff. So talk me through what that process looks like and what my options would be.
Right. Well, I think first of all, if you want to buy it, because of the volatility point I just mentioned, I wouldn't suggest buying it all in one go. I'd suggest buying it over, either once a month, just go and buy some, or and if you're going to do that, you may want to say, right, I've got enough for 8 months, or I've got enough for 4 months, but I wouldn't go all in, because you're unlikely to get it right, if you know what I mean. And I think one of three things will happen: either the price will go down, so you can then say, well, I want to buy some more, but I'm buying it cheaper. The price will go up, in which case you might go, well, actually, I've made enough, so I'm not going to put any more in. I'm very happy with what I've got. Or the price will stay the same, and if the price stays the same, if you want to put some more in, you can. So I think that's the first thing. I think the second thing is, there's a massive misconception with gold that you have to take delivery. You need to check with your dealer first, but most can store and insure it for you, so you don't take delivery. I bought a lot of gold and silver over the years, never seen any of it, because I get it stored and insured with the people I buy it from. So I think that's very relevant. And then I think the other thing that's relevant is how long you intend to have it for, because if you're going to have it less than a year, it'll probably cost you about 4% ish to buy it. When I say 4%, the bullion dealer has to make money. So what they tend to do is, if you buy it, you'll buy, let's say, $100 worth, £100 worth, and they'll charge you £104 for it. And then you've got storage costs, which are probably 65 basis points ish. Obviously varies from dealer to dealer. But then you've got a sale price. So again, how they make money, 4% is not a bad proxy. So let's say it's worth 100, they'll give you 96 for it, kind of thing. And so because of that, I don't think gold, I think it's great for a longer term investment. We'll say longer term, I think more than a year. So that those costs I just mentioned get kind of spread over more than a year. If you're looking to buy very short term, then I think an ETF is probably better for you because they're much cheaper. So yeah, I think that's a good way of entering the market. I mean, I think the other thing I would say is never go for cheap gold. You know, there's a lot of fake gold around, and so you want to go with a reputable firm. I describe it a bit like buying fine wine, to be honest. If you buy it and it's never left the premises of who you bought it from, one, you know it's been stored well, and so does the buyer. Two, there's no reason to question its integrity because it's never moved from where it is. And I know some people will go, well, actually, if I take delivery, then I don't have to worry about storage and insurance costs if they don't want to tell their insurer about it. But if you do that, you've then got the issue of selling it at the other end, and whoever you sell it to is perfectly justified to say, well, actually, I want to test it. And there's a time angle to that. There's a cost to that. I don't know what it is, but and obviously you need to transport the gold back to them, and there's a cost to that. So I generally kind of would much rather them store and insure it, because you know you've then got the hassle of all that when you come for the sale. So even though you can save some money on storage insurance, 65 basis points of what you've got. And I think it's worth pointing out that gold on average has increased in value in sterling terms over 10.6% a year since 2000. So even with 65 basis points, you know, you should still make a decent amount of money.
So there seems to be some comparisons between, let's say, the S&P 500 and gold in terms of both performance. I think the S&P 500 comes out about 11-12% a year as well. But then in terms of fee structure, it also seems to be like there's obviously a purchase fee for when you buy something from the market, a selling fee, you know, that kind of transaction fee. And then it also seems to be that management cost. So, you know, anyone with a pension or, you know, a long-term fund will kind of see that cost as well baked in. How does that work? So if I've got physical gold, let's say, well, actually, here's my first question. How much would I need to get started to buy physical gold? Is it like a trading 2-on-2 account? I can get started for £1, or would there be a minimum entry point?
I think you need to check with your dealer, but I think a coin would probably cost you about 200 quid. And we're talking about a very small coin. It's probably about the size, well, it's probably less than the size of a 1p piece, more like half p piece for those who remember that. But it's you don't need a lot of money to get started, is my point. And in terms of, you know, what I do in terms of what I actually teach people how to invest in gold, because I think it's one thing knowing why you want to invest in gold, but it's something entirely different to know how to invest in gold. And but it's if people are new to it, then, you know, I would suggest start with I use a fantasy football format, and I'd say start with the more boring side of life, and then as you've got more money, then you can kind of take more risk. But I wouldn't advocate buying explorers and higher risk producers until you've got a decent chunk of money in more boring companies.
And these are all of the companies that are involved in the gold process. So these will be the people who go and find gold, refine it, produce it, mine it.
Yeah, I mean, I'd say I don't include refiners, but I include all these companies will process it. So basically, what tends to happen is the gold will be dug out the ground and come in ore. The ore will get processed. You'll get gold doré, and then a refiner will actually refine the gold doré and stamp it with their mark. So a buyer would say, right, this is metal or gold, whatever it is, and that's the kind of stamp of credibility, for want of a better term, that you feel you've got a genuine bar of gold.
And my hunch would be a lot of these explorers would be similar to those who work in oil and gas, for example, or like maybe like a hedge fund strategy where they tend to not make a lot of money most years or take quite a big loss, because I imagine that exploration is expensive. But when they, no pun intended, hit gold, that's when they make a return, and that's why the risk is so much greater.
Yeah, I mean, I think this is, you're a classic case of someone who, if I'm honest, no one really understands the market, but it's kind of an explorer. You have a producer explorer who's producing gold, generating cash, using some of that cash to explore. And if you're producing, you're kind of de facto exploring as well, if you know what I mean, because you're kind of you may come across seams which have got more or less gold than you thought. But you then get explorers that are generating no cash because they're not producing, and the way that they fund another round of exploration is that they have to raise capital. Now that they're not generating cash, so they have to raise capital by share issuance. And so if every time they issue shares, they dilute the existing shareholders. And so that's the kind of, in all honesty, that's where I can provide the most value in terms of what I do, because people don't understand the market. And whilst I think it's nice to have a few explorers in your portfolio, I'd be much more comfortable having a lot of producers, because it's producers who are generating cash, and at the end of the day, kind of that's what you want.
So the least risky is owning the physical gold, and then what are the kind of steps above that? Where would owning the shares in a producer sit on a kind of in my risk barometer?
Okay, well, look, let me kind of just go through it. In my football analogy, I have the stadium, which is your physical gold. I then have a training ground, which is a fund, so lots of companies. I then have a goalkeeper, which would be a multinational, very large, probably 15 billion plus, 20 billion plus market value. I then have a defender, which is a large company, a large producer. I then have a midfielder, which is probably either new to production or much smaller, perhaps dependent on one asset. And then you have a forward that's an explorer. And what I say to people is, if you're going to play football, you can't play football without a goalie. And so it's the same with when you invest. You need a full complement. And depending on your appetite for risk, you may have one forward and lots of defenders, or you may have three forwards and fewer defenders, or fewer midfielders, whatever it is. But you kind of you set the team up for you, and if income's important for you, then goalkeepers, defenders, more likely to pay dividends, so you make sure that they're dividend payers. You might look for a midfield that pays dividends. Your forwards certainly won't. But then there's different levels of risk on forwards. You could go for a forward that's looking to raise money to take a project into production, so they're not actually producing. Or you could look for a forward that's never made a discovery, and they're two completely different ends of the spectrum. Or you can pick a forward that's made a discovery but is looking to build out to get a commercial level of gold. So there's loads of different components to that, and people kind of don't understand it, and that's what I help them with.
But underpinning that is the infrastructure of the team. it's the stadium they play.
Exactly. That's 100% true. I mean, basically, what you do is, if you've got a lower appetite for risk, I describe stadium, training ground, goalkeeper, defender, and midfielders as an investment. I describe forwards more as a speculation. And what I like about the system is you're looking to make a good return from the portfolio. And I liken it to, as I say, fantasy football. At the end of the season, it's whoever's won the league that's, that they're the champions. And pundits tend to put together their team of the season. Now, whoever's won the league, you'd expect them to have a lot of players in team of the season, but they won't have all of them. And it's the same with investing in gold. Are you going to get the best companies in your portfolio? No, you won't have all the best ones. You may have a few losers, but the whole idea is you win the league. And I think people kind of, I don't know, they forget that, and they want to, they have an investment that doesn't work out, and they beat themselves up, and they never touch money again. And I think that's a mistake. I think you need, you need to understand what you're going to achieve. And I think it's, going back to the football. If apart from a die-hard fan, if you said who won the Football League 6 years ago, you could probably mention the team, but I'd be very surprised if you can mention any of the players. A die-hard fan probably can, but most people may mention one or two, but they probably won't mention more than that. And it's the same with investing. You want to make money out of your portfolio, but you probably won't be entirely sure exactly what your best investments were, but that's not actually massively relevant. The idea is you make money.
So, Simon, you've convinced me. I want to buy physical gold. Now, you mentioned about going to a broker. I know nothing about buying physical gold. How do I know if the broker that I'm approaching, I've done a Google search or whatever, how do I know they're reputable? What would be the telltale signs to go, yes, you can trust this broker over this one?
There's various things that I'd look out for. I'd look out for how long they've been established. You want someone who's been established for a good few years. You don't want someone who's just got established in the last year or something. I think awards are quite good. If they've won awards, I think reviews are very good. It's worth checking out their reviews, and it's worth phoning them up. You want to phone them up now. You don't want to phone them up when you've already opened an account. And if you're happy with the service, they're very professional and they're decent. And I think the other thing I look for is, even though there's not so much an authorized dealer, what you tend to find is quite a lot of dealers are they've got a connection with the Royal Mint or Canadian Mint or some body, and I take a lot of comfort from that. If I see that there's someone is the official distributor for the Royal Mint or something like that, then that's a good tick point. And I'd probably speak to them, and then I'll probably go onto the Royal Mint's website and see if they've got a list of distributors. And if I was remotely concerned, I'd probably phone up the Royal Mint and say, if they don't have a list, and say, look, thinking about dealing with these people, are they one of your distributors? And I'm sure they've got a list, and they say, yes they are, no they're not. So it's quite easy to check people out. And there's some very good firms out there, so I wouldn't put people off using one of the better name firms. I've got a book which covers them, but you've got people like Bullion by Post, Pure Gold Company, Sharps Pixley. These are all reputable firms that I actually buy gold from all three of those. It's a good way of starting off.
And let's say, for example, I've got somebody who goes, well, I can't quite get into physical gold. I'm just starting my career. I need but I would like to dip my toe in very, very gently. You mentioned about ETFs. So these are exchange traded funds that deal with gold. How are they structured? Would these be shares of companies that are in the gold industry?
They vary enormously. I mean, I would say that going back to someone starting out, I mean, 200 quid is the minimum that you can invest in gold. And I think the other thing I'd say is once you've had it, if the price keeps going up, then after a point it's like a proxy for cash, because you can sell it really quickly and get cash in your account. Going back to ETFs, they vary enormously, and you need to be very careful about what you're buying. About 75% of them are backed by physical gold, but not all of them are. So you may find some that have got an element of physical gold. They may have some shares. They may have some derivatives and things like that. So if you want to get into that market, then two things I'd look for is size. I'd go for a larger one, and I would obviously look at costs and look at sort of what they're investing in. So that's not a bad way to start. You've obviously got physical gold as well, and then mutual funds, which are companies. But I think one of the big differences you tend to find between perhaps some funds and others is some funds are what I describe as passively managed. So they probably have an index, invest in an index. So they tend to be quite cheap. A lot of ETFs I like that. And mutual funds are actively managed. So they've got a team of people, the natural resources team, that's saying buy this, sell that, buy this, sell that. They're more expensive, but you've got a good team and they make some good decisions, then they can outperform the index. So it's really up to the investor. But I would say, if you're starting off, I'd go for the lower risk side of life. Lower risk side of life, sorry.
And this would be my final question to you, and we see this a lot in the stock market, and I think a lot of people have seen this with the gold price recently. A lot of people did it in Bitcoin as well, which is hits all-time highs. Is it too late for me to get in?
No, I don't think it is, and I would say, going back to the MIDI that I discussed earlier, market uncertainty, interest rates, debt, and inflation. Now, they're all kind of pointing. I think the direction of travel is going to be upwards. Speed of travel less clear, because obviously you have corrections, and but I would say to anyone looking to get in, then do it sensibly. You can't control the market, but you can control how you invest in a market. And because of that, you can't control what's going to happen to the gold excuse me, the gold price, but you can control how you invest in the market. And so I would say invest in average price in, and for that matter, average price out. I wouldn't say, let's say you do well. I actually sold some positions last week before the crash, but I didn't sell all of it. I just sold a bit of it. In hindsight, I wish I'd sold all of it and could have got back in a lot cheaper today. But I could have sold all of it and the price could have continued going up. And so, you don't know. I think another really important point is you're going to get things wrong. So don't beat yourself up if you end up buying and the market crashes, or selling and the market flies. It will happen. But I think if you've invested sensibly, then you're kind of investing over time, and that's how you do it.